Hello, ladies and gentlemen, and welcome back. Well, the CPI numbers are out, and initially the market seemed to love them, right? Well, yes, the inflation numbers were down, but the problem sectors, the sticky inflation was still present. In today's video, we discuss those reasons why the inflation number was maybe not all it was cracked out to be. We'll also be discussing the idea of what actually occurred here. In the first 10 minutes of the CPI number, we saw an incredible ramp in price. Then all of a sudden, markets didn't like it anymore and they filled gaps. What happens now in the next 24 hours is very important. Jerome Powell comes out with no doubt a interest rate hike, most likely of 50 basis points. On top of this, we also know that the markets will be looking very much at what Jerome has to say about the economy. The worst thing for him right now and the Fed has to be a runaway bull market. So will Jerome do the same thing he's done in the past? Let's take a look at the stats of what happens on Fed rate hike day. Well, welcome back everybody to the Daily Show. Of course, as per usual, we'll be going through a whole bunch of information, macro data, lead indicators, key levels you should be looking at. But let's start with the news stories. Of course, CPI data. So CPI data came in with an increase of 0.1% in November and core CPI increased to 0.2%. Both were under expectations. And it brings us to an interesting point in markets. If you looked at it on the surface, it looked pretty good. Energy was down heavily. Used cars were obviously falling off. I don't think that's a surprise to many people. The biggest issue has to be here. The index for shelter was by far the largest contributor to the monthly overall increase. I tweeted about this straight after the report came out as the problem. And then from that level, the market went straight, literally right down. Also, if we take a look at CPI month over month, we'll see a very encouraging sign, which is that inflation's dropping. And we've already said that we believe inflation will come under control. The question now is whether the food and beverage and shelter areas end up kind of remaining sticky or they fall off. The Federal Reserve will not want to make the mistake of the 1970s. And for anyone that's followed that mistake, what happened was they started cutting too soon, and then inflation came back and caused all sorts of havoc on the market. The general rule is this: inflation must drop underneath the federal funds rate. So once we get underneath the Fed rate and we stay underneath there for a period of time, and especially if we see a drop in food and shelter starting to come through, that will be the tick of approval that the Fed's able to therefore support the economy. They do want to do this. We'll look at yields a little bit later. So as we check out this chart, you'll notice that all items except for food and energy were down pretty heavily. The trajectory is nice for that. And of course, all items in general, mostly helped by used cars, energy, those types of sectors, was down. The lowest reading we've seen for quite some time during 2022. So is it all good news or is it bad news? What does the market do next? Well, make sure you always do look at the Bureau of Labor Statistics and go over there and have a look at their reports, because of course, this is where you get the real breakdowns. As you can see, the changes here, and you'll notice used cars, also things like energy were the main contributors. And if energy does spike up through the month of December, expect that probably food and shelter will continue to be problems. And we may see actually a higher read in January. This is something that's going to be very, very interesting for the markets. Do also follow along at FX Evolution on Twitter, as I'll be posting up a bit of a change in what's happened with the federal funds rate moving forward through the back end of 2023 and 24 later on today. And if you follow along there, of course, you'll be able to get access to that chart. Certainly one that you want. It will give you edge. This is the type of report you need to see for 2023 to make those better informed investment decisions and understand what the markets are doing. So what happens on the next bit of news? The federal funds rate hikes. What tends to occur? Well, stocks generally have sold off on Fed Day lately. Let's look at some of the stats here. We have the November. We see the change was bad. We have, of course, federal funds rate hike here in September. Well, it was bad. Now, before that, we had some positives followed by kind of lackluster days. So whether it was on the day of or the day after, traditionally we've been giving up a lot of the gains. Look at these reds here coming through. Very interesting stuff. If we have a look here, how stocks have done under the days, again, the last two reads have been negative. There's been plenty of negative ones throughout 2018, 19, 20. And then there was mostly positivity around it, followed by negativity the next day. But the last two certainly haven't been in Jerome's favor in terms of the market going up. Now, why is that? Because he doesn't want it to go up, frankly. He wants it to stay at lower levels. If the market gets carried away, the bull feels like it's back in town. If that happens, that is very detrimental to the Fed and the US economy. He does not want that. So what are some positive signs here for markets moving forward? Well, corporate insider sales may have started to bottom off. Basically, we're not seeing actually a huge amount of selling going on through the corporate insider sales. This is showing you that they're pretty comfortable with what they're seeing from their companies, or at least they're not willing to effectively sell low. They want to sell high. And that's what they've traditionally done in the past. So is this a bottoming pattern similar to what we've had before? Something to look at, something to keep in front of your charts. Here's one for XLK, very similar corporate insider sales. It's definitely lower than it used to be. Usually they'll sell into rallies. That's what they've done in the past. And when they think their stock valuations are a little bit high, they're not currently looking at that. So interesting stuff coming out of one of the weaker sectors of 2022. They're not concerned. We also brought up the MACD switch literally only a few days ago, where we got a MACD going from positive to negative. This switch, of course, with the statistics over the next coming weeks and months, usually points to a negative market. So it's just interesting. I shared this on Twitter if you want to check it out. 2 weeks later, 1 month later, 2 months later, and 3 months later, traditionally after these figures, we've seen negative markets. Now, that doesn't mean it has to happen. Of course, 75% of the time that has been what's happened. That's a fairly strong statistic in the negative direction when we've had this MACD switch with a declining 200-day moving average. An interesting stat, certainly worthwhile checking out. Will Santa come this year? Well, we've talked about this many times. Traditionally, during bear market years, he doesn't come. Santa is thinking we're all really bad, usually. But this is around the point in time where markets tend to have that rally coming in. Around the 15th or 16th of December usually begins these rallies, sometimes even the 14th, which we're on at the moment. And if it's going to buck the trend, it really needs to do so this week. So let's jump into the charts now and take a look at the VIX to start off with. As we know, we got a gap up similar to the other breakout of the downward channel. It's actually looking pretty similar to those. Then we saw a pull down. That pull down was thanks to the inflation numbers coming out. Volatility instantly dropped after that. The reason why? Well, the number was a little bit better than maybe expected. The markets rallied heavily and the number was over. So that meant that the volatility could drop out of options. You can just see how much this market pays attention to CPI. So will we get the turn here towards the negative side? Well, that's something that we'll find out very soon. But VIX still on track to be very similar to previous rallies into our trend line. One of the charts that we've been talking about a lot has been the 3-month versus the 2-year. We expect this to continue to increase. That is effectively 3-month yield to continue to be high. That's going to be the Fed and where the Fed funds rate has to be, and the 2-year continuing to drop off. And the main reason is because the Fed is making the economy sick. They're going to be forced to hold rates while they try to get rid of this sticky inflation. If it continues to persist, they'll have to hold rates longer, which the market will hate. And more damage will be done to businesses, to zombie companies, to valuations, to all these things. So think of this as the war between the market and the Fed next year. Fed on this side, market on this side. It's going to be a very interesting chart to look at. What about the forward yields? What happened there? Well, we saw everything drop. Basically, we go into September of 2023 now with a 4.755 terminal rate, which was where the federal funds rate was going to basically end, still sits around 4.8 between April and March of 2023. And the most interesting thing was just a little bit more cuts, not really any new significant lows or anything, but cuts still being expected to come through fairly heavily back end of 23 into 24 into 25. The Fed will need to support the economy. At least that's what the market's saying. Remember, 2023 will be about valuations and that 3-month versus the 2-year. How sick is the economy? The markets versus the Fed. Let's talk about TLT. This is bonds. This is where a lot of people have been very excited about this one. TLT didn't really have a stellar day. It was up 1%. Again, if we end up killing inflation and we end up being able to cut rates, that's going to be a good thing for treasuries. That's actually what you want to be seeing. So there's no reason to hate on treasuries right now, like TLT. I still think that it's a pretty crowded trade, so there's a potential for a pullback here. But don't chase things. If you have, it depends what your time horizon is. I'm not much of a trader for these types of bonds. I'm usually more of a person that looks to it for a medium to long-term hold. But yeah, I think TLT is certainly a very interesting choice and decent. Here we've got the weekly for high yield bonds. Notice they gapped up and then fell down. This will be one we're watching. Does high yield bonds start to drop off? If they start to drop off after the Fed and the market's still hovering around or even buying up, that could be an early warning sign similar to what we used previously that something is not right. Watch high yield bonds. This will be one of our lead indicators. PCC, put call ratios. A lot of people were jumping into calls, probably retail traders in the previous 24 hours. That's a good sign for, of course, what we potentially want here, which is maybe some shorting of the market around that key technical zone. And we saw the PCC come down, showing us that calls were entered in the last 24 hours. What about the US dollar? Well, it had a bad day. It fell off. We pretty much were, guessing really coming into the CPI numbers. We knew it would be a wild one for it, whether it was up or down. And dollar index just slammed straight into these daily, weekly levels over here at the 103. It does look like, continuation of US dollar being pretty weak. We're still going to leave these alerts for potential bulls to come back. But at this stage, would you be still bearish into this level? Probably not. A lot of people would have taken profit, you would think here. And you can see the initial reaction to that zone had a little bit of buyers in it. So it's just floating around this demand. Dollar is probably a hard trade till we see what the Fed happens. And we'll obviously update it from that point. Gold spiked a new high. Pretty strong for gold. Gold's been doing that series of higher lows recently. This was a key level for sure. It still could be part of a Wyckoff distribution. It is possible. Is this a false breakout? Well, we're going to find out. What if it ends up being like this over the next 24 hours? If that happens, lower high, all of a sudden you're talking about shorting gold in the interim, not the long term, not the medium term. We're still bullish gold in that. But on the smaller timeframes, that's what we'd be looking at. This is still a distinct possibility, and you'll see my reasoning across a whole bunch of sectors in the stock markets as well. It was a great breakout. It looks really good, obvious to a lot of people. It will make people want to buy, and rightfully so. It's a huge, huge move. But if this ends up being a rejection for the week, that's going to be very interesting. What a week this is. It's got a lot of ramifications, I believe, for serious money flow over the next coming weeks, if not even month. Let's move over to US oil. US oil hasn't hit that 77. We've been looking for a rally into 77, then potentially some problems. Again, Fed result coming out in less than 24 hours, plus a whole bunch of other central banks around the world. Do we reach this area and then see rejections? This will be the zone to watch, I believe. And at this stage, oil still maintains that kind of weakness into ideally the 65 on the medium term. And it's still in a downward trend. I mean, there's no way that you can say this is like, looking super, super bullish or anything. Some people pointed out down here is a double bottom. They've gotten that first target. Will we get the second target? Over here, though, that drop, base, drop, there should be some testing of that zone, hopefully over the next 24 hours. Now we go to the elephant in the room. So you would think during a good day in the markets that Tesla would be up. Well, no, it wasn't. People are really starting to lose faith in this stock. And I think it's got to do with just consumer discretionary in general not being a super hot sector and people being seriously concerned about the credit cards that we've reported here on the channel several times. The American consumer is borrowing. All of their savings are being dried up and there could be a sickness on the way that's going to affect some of these high ticketing yields. Now, at the same time, we've got the whole Twitter saga going on. And we do know that this is not a good look for Tesla. If Tesla ends up closing a new low here, maybe our 136s do come true over the next coming weeks. I've been pretty negative on this stock really over the last month. And the main reason is because I can just see the compression coming in on this particular sector. I've been following consumer discretionary a lot recently, and I just see it time and time again, series of lower highs and all sorts of things like that. So it did break down, pretty big volume on the session. We do know that, of course, we have options expiration this week. It's unlikely that the market will want to close Friday below 150. They won't want to pay these puts out, you would think. Still a lot of open interest here. All the poor calls, they're going to be sad faces. It doesn't look like they're going to get paid. So max pains at 185. You could see a temporarily rally in Tesla. That is possible. It's not going to be easy to pick though. If you're a longer term kind of player on Tesla, you really do want it to come down into these levels to give you the opportunity to buy previous gap fills. Remember, there's a reason we have 136 on the charts. That's actually a gap that started a huge rally. This was clearly a battle zone between the bulls and the bears. So it's a good structural point to see the markets come back down to. Will 136 be reached if the market sells off? This is not currently a strong stock. So you've got to remember the flavor has come out of here. They're moving into others. And if we see cracks in some of the sectors we'll talk about in a second, Tesla could continue to fall down. Be careful here. Obviously have your plans, have your risk management, but that's not a good close. If the weekly closes down like this, it's not going to be that solid. Let's move over to Aapl. What happened here? Still putting in lower highs, interestingly. Look at these, lower peaks or lower highs. So it gapped up, had a great start to the session, and like everything else, filled that gap. So effectively, it's now reset itself to allow potentially a rally, and then we find out from the Fed what Jerome's going to do. Jerome's best interest is to drop the market. I doubt he wants it higher. In fact, I doubt he even wants to create a rally. So this will be a very, very interesting Fed discussion, and of course, to see what they do with rates. How will the market react to that? We do know where we get those kind of sell triggers that push us probably to a 3750 on the SP 500. That's that 140 low. We've filled down, and at this stage, at least in the rallies, we're not seeing strong breakouts. Now, if we get a new high here, well, we'll have to consider whether that means there's a new rally coming in for Aapl and a new rally coming in for stocks for now. Haven't seen it yet. We'll come back to this stock. Let's now look at some of the sectors. Consumer discretionary versus staples. New low. Interesting. Bad looking candle on the weekly. Should it close like that? Let's have a look at the daily. There it is. Gaps up, goes down. Again, American consumer stocks not looking so good in comparison to defensives. XLF, financials, nice movement up, now pullment back. This is going to be in line with that 61.8 kind of area of a pullback. So that's a Fibonacci. So yeah, again, if it's going to weaken, new lows, we've got alerts set, not going to be a good sign should that happen. This could still be part of accumulation, or it's all part of a huge amount of traps. And I think semiconductors is still going to show us the way here. Let's take a look at semis. Great start to the session. Absolutely jumping out of the gates and super strong, and then fell off. Didn't quite fill perfectly the gap here on the semis, but they fell off pretty heavily and then closed. Let's just theorize a concept here. What if the market, which has currently been in a beautiful either distribution or accumulation, still not proven, just false broke? Now, for a few of you that know Wyckoff, you might call this a UTAD or a UT, and you'd be like, oh, look, that looks like a false kind of break. So far, we've had a new kind of high being formed here just, I believe, or right on it. So that could be that first kind of false break. Then we get a lot of people FOMOing in. What if we hold here during the Fed and then the next session go down? That's probably going to be a trigger point towards further selling. I think this is the chart we're going to watch the most over the next couple of days. It may not happen, but you've got to think like this in the markets. You've got to say, okay, if this scenario happens, does this scenario give me edge? That's the type of thing that you've always want to think about in markets. Over here with XLE, that's something we did. A bit of a rally, long leg doji or a doji here. Basically indecision. 88 is going to be a problem for XLE stocks. Obviously, they've rallied up a little bit. Will they sell back off? We've got the distribution already in. It really comes down to also whether oil comes up to that level and then starts selling off. That will put pressure on these energy stocks. Let's look at the DAX. Big rejection week number 1, coming still through that supply zone. Next 24 hours will be very important. Do we do something like this? That's something that we'll pay a lot of attention to. A close above this alert level up here, sitting around 1470 is going to be now very important. This is something that I think traders will want to see. Let's move over to the US 2000, another huge rally coming back up into these close highs and then instantly rejected off those areas. Interesting that the market would do that. Are they selling into retail traders? I'm sure a lot of people were trying to buy the drop, thinking that there was going to be a continuation similar to other inflation numbers. If you actually look at some of the other inflation figures, we were doing this, they've tended to lead into some serious movements, and markets, and I think a lot of participants have seen these types of things and they've jumped on board the rally train. Well, it was a bad idea to jump on board the rally train over the last 24 hours, unfortunately. Hopefully not too many people got burnt by that. Let's move over here to the US 100. Hits into a new high, takes the high, hits the trend line, that's the NASDAQ trend line, and then sells off that level. Of course, recovery currently, will they then drop it back down? Well, we'll have to set alerts for new lows because we know that's going to be significant. Why? Because if we end up getting a new low, that's a trap. And once you have the evidence, as we say, patients react, we see a trap, well, that means that probably will continue to go in that direction. And that was set very, very well. Let's move over to US 500 here. We'll just quickly put the analysis of the real market in. Interestingly, it couldn't hold the gap close, which sits at 41.10, the technical gap close, and it actually opened right on the same high. So that price is sitting here at around 4,100. It literally opened there, but it was already selling off into the open and then just sold off, filled the gap, and then closed at that zone. So again, could this be part of accumulation or is it part of distribution? Be open to both sides. We'll probably find out in the next, few days because we've got so many options expiring. We've got the Fed, we've got all these things. Now let's move over to this complicated looking chart, which is the US 500. We do know that big trend line's there. We also can see that this spiked a new high, hitting into all of these previous levels that we had, monthlies, unfilled gap, daily level closes, previous resistance, previous supply over here, very critical zone where it ended up going to, one that we've had on the charts for quite some time. Then we go down to the 2 hour and we can see that it was finding this level, sitting around here, which was that potential supply, and then the market just went ballistic up. It then came straight back down, hit into this area where it was building before the CPI. And if you were watching the CPI release, I'm not sure if I can show it here on a chart. Let's go to the 1 minute. It was super dodgy, and I'll show you this in the chart. Let's have a look here. So why I'm saying it was super dodgy is because there was some big orders that came in initially. See this? Few minutes before, I was watching live and I was like, there we go. Probably some dirty leak. There was a huge amount of orders that just suddenly floated in on a buy. And then, of course, the real number came out and that was chunking. There was absolutely no liquidity in here. In the space of 2 minutes, it already got up to this level. And if you had executed in this, and this is the problem with news sometimes, you probably tried to buy here and got filled here. These are the dangers of news buying. So you can really see that big pull up, the initial drop, that rally that goes into the closes, which is up here. And then, of course, the rest of the session, it ended up dropping off. Now, if we take a look at the 1 minute, you can see it's kind of melting up higher. The expectation at this point is that you could certainly think about 40.50 or even 40.80 being key zones that the market could rally into. 40.80 in particular is an interesting one. It's like a 61.8 fib pullback of that drop. This could be where the bears sit if they're going to. For the bulls, what you want to see is a new high getting reckoned with. 4,200. At the moment, it's hard to say that you should be bearish on this market unless you're using options, because we do know that it's back down to that initial supply, which at the moment looks like it's demand. We saw the initial reaction. It's gap filled, so that allows the market to potentially move up now. And you do have to go with what the current trend has been, which is 4 hour swing, where it's just such a critical level. Options have been the best play here because it's protected you from both of these positionals. At this stage, we know that this supply is still holding. It's been tapped properly now. Will they get control? Will the Fed win and actually push this market back down, which is probably their ultimate goal? They want to sit the market probably somewhere between 3250-ish and maybe 4K. That would be perfect for them. That's absolutely the optimum for them to actually get the job done. And this is what they want. So can they get it done? We'll find out. Let's have a look at the options. Make sure to refresh this straight into the open over the next 24 hours. You'll see a whole bunch of changes that will come through. We've still got the 420 on the high end for this week. We still have the 380 on the low end, and maximum pain is 392. So stock price is now above maximum pain. That's an interesting one coming off the Fed. If we see a hike, let's say it goes to something like 40.80, and then the Fed comes out and starts selling it, where could it go? Maybe they want to move it to maximum pain. Trillions of dollars at stake, 6.044 million units. That's a ton. All right, let's have a look now at Bitcoin. Move over there. Bitcoin front run this move. It hit 18,000 as well. Very nice. So Bitcoin did end up front running. It was moving up way before the inflation numbers. It ended up going into 18,000, which was that initial target to the bull side. It ends up that this was accumulation, and that's how it ended up playing. Yeah, look, with Bitcoin, we still probably maintain the same thing. If the stock markets do weaken here, Bitcoin will weaken with it. And it's moving into, I guess, what you would say is a pretty critical zone. I think this is a very, very fair level to see some sellers try to recommit. 18K is a big number. And anywhere between these wicks here, as you can see, between 18 and 18.5, you've got a lot of previous supports becoming resistance. So tough level here for crypto. Really depends on the Fed over the next 24 hours. Speaking of the Fed, let's check out the numbers. And we'll go down here. Oh, I was on one of the other numbers, so we'll go over. Just looking at the last PPI. Here we go. So we'll check out this week. And we have here the FOMC, obviously, statement, funds rate, expected 50 basis points, and then the press conference. Remember, the press conference is usually the big mover. The funds rate might move the market one direction. The press conference is designed to hopefully get the job done for the Fed, that is, push it in the way they want to. But it doesn't stop there. Central banks around the world, core retail sales, and then, of course, we go into the Friday. We've still got 9:45 New York time, flash services PMI. So the news doesn't stop rolling this week. We've got trillions of dollars at stake. Theoretically, when you're talking about maximum pain, the Thursday before the options expiration tends to be the negative one. And as we know, that also would hold up with some of the stats that we saw earlier. It's going to be a really tough week here. Be prepared. Volatility is still set to be extreme. Thanks so much. Subscribe, smash that like button. We'll see you in the next one. Bye for now.